Hi there, and welcome to Accounting 1. Congratulations! You are about to complete Accounting 1. Your Chapter 9 material is both interesting and challenging. You will be working with accounts receivable. You started working with accounts receivable in Chapter 1, and now we are going into more depth. When we are talking about accounts receivable, we are talking about credit transactions. We have granted a customer credit to purchase our goods or services, and we are entitled to receive money in the future. American businesses run on credit. In all likelihood, if we did not grant credit to customers, some would not be able to purchase our goods or services, and we would miss out on those sales. There is always a risk when we are granting credit. Some individual or company may not pay. When that happens, we have a bad debt expense. We have more than one way to deal with bad debt. If we are a small business, we may use the direct write-off method. The method is allowed for small businesses but is not allowed for generally accepted accounting principles. Remember, GAAP. The method that is, who knows what's going on there. This method is that when we have knowledge or evidence that our customer will not pay, we eliminate the account receivable for the customer and record the bad debt. For a medium to large business, we must use GAAP. This requires the business to accrue an allowance for bad debt at the end of the year. If we grant credit to customers, we know that some individuals or companies probably will not pay the bill. We cannot predict which company or individual it may be yet, but we know from experience that it will happen. At the end of the accounting period, generally at the end of the year, we determine how much will be uncollectible and record an adjusting entry to an account called allowance for bad debt. This is a contra asset and is immediately associated with accounts receivable account. It is often a sub-account, or it can be the closest account by account number. Each year, we make an adjustment to the allowance account. If we have evidence that a particular account is not going to pay us, then we write it off. The method to do this is to reduce the allowance for bad debt account and eliminate that particular account's receivable. What's happening here is that we reduce the estimate because we now know whose account is uncollectible. Because different businesses have different focus, GAAP gives us a choice of the method of accounting for allowance for bad debt. You can use the percentage method of sales, method for the that relates to accounts receivable, and we're talking about credit sales here. The percentage of sale method is looking at credit sales for the year and develops an estimate of the amount of credit sales that will be uncollectible. Each year the business will go through the same process to calculate the amounts for the adjusting entry. For the balance sheet methods, we have two additional choices. A business can use the percentage of receivables method or an aging of accounts receivable. It is important that you know the primary difference from the percentage of sales is that in the balance sheet methods, you must come up with a balance in the balance for allowance for bad debt account. Your amount of the adjustment is a forced figure. Make sure you take time on doing both of these methods. You will definitely have test problems on them. The last part of the chapter is about notes receivable and its interest. A note receivable is it's very common when we sell items to our customers and allow them to pay several months later. Since there is a passage of time from the initial day of the transaction to the receipt of the payment, we are entitled to receive interest. This is a brief overview of Chapter 9. Take your time, do the practice homework, and you'll be glad you did. Thank you for being in Accounting 1. Bye.